All right, let's get you up to speed now on the market action. We want to bring in Michael Jones. He's broader markets with Caravel Concepts, the CEO there. Michael, it's great to see you. We're talking about the losses that we're seeing in the markets today. Of course, the worst September that we have seen since 2008. The quarter has also been relatively ugly. So where do we go from here?
Well, I think it's important for investors to recognize that the sell-off continues, but the motivation for the sell-off has changed dramatically. 6 months ago, we were selling off because inflation was soaring and we were afraid it was out of control. We're now selling off because the markets and investors are afraid that the Fed is out of control. We have had, since 6 months ago, a lot of good news on the forward-looking inflation indicators. Money supply has gone negative, commodity prices have crashed, rents are rolling over, home prices are coming down. All these forward-looking indicators of inflation look good, which is why we rallied during the summer. But what Federal Reserve Chairman Powell's Jackson Hole speech reminded investors is all that forward-looking stuff only matters if the Fed thinks it matters. And the Fed is not looking at that. They're looking at backward-looking measures of inflation, and they're going to keep tightening. And we now, to decide when the market settles, when it's safe to go back into the water, we have to decide what Federal Reserve Chairman Powell is going to do. And that's a much riskier, much more difficult proposition than looking at inflation.
And we heard from Fed Chair Powell it could be between 100 and 125 basis points that get raised between now and the end of the year. How prepared do you think are markets for what's coming ahead?
I think if he fulfills that pledge and then says we're taking a pause, I think the markets, the S&P has very strong support at about 3,400, another, please swallow hard, another 7% down. Then I think if that's all he does, and then he announces a pause, we can probably hold at 3,400. However, I haven't seen any language from the Fed that suggests that they will be done after another 125. I'm afraid that they are looking pretty predominantly at unemployment. They want to see a lot of Americans lose their jobs because they believe that only with higher unemployment can we bring down labor costs, and only by bringing down labor costs can we bring down inflation. That's kind of the old model of inflation from the 70s that was undermined by this notion of stagflation. But that's what the Fed's looking at. So until unemployment rises, and maybe rises appreciably, I'm not confident that he's going to stop raising rates.
So you're suggesting what would then bring down inflation, if not bringing the unemployment rate up to 4.4%, the Fed's estimate, end of year?
Well, first of all, let's recognize that there's zero historical evidence that raising the unemployment rate brings down unit labor costs. That's what they thought in the 70s, and it didn't work. That's why the word stagflation was invented. What brings down inflation, in my estimation, is what Paul Volcker believed brought down inflation. Stop printing so much money. And the Fed, combined with the private sector banking system, has already gone a long way towards achieving that end. We had money supply hit 25% last year. It has since collapsed to negative. So that's a huge swing in inflationary pressures. And don't just take my word for it. Look at oil prices, copper, lumber. All the major commodities are down 30, 40% because the oxygen that supplies a rally in commodities is printed money. And we're not printing money anymore. That's the mechanism that brings down inflation, in my estimation. I just wish it was the Fed's estimation as well.
Michael, taking that into consideration, what's the impact then of the Biden administration passing the CHIPS Act, student debt forgiveness, $400 billion, and the Inflation Reduction Act?
This is the kind of trap that we see more explicitly in the UK, where you have the monetary policy at odds with the fiscal policy. And if you are an old-fashioned, a cost-push inflation believer like Powell, then every time that deficit goes up, he's just raising his target on interest rates. And that's, we obviously haven't seen the kind of extreme crisis that we saw in the UK, but when monetary policy and fiscal policy are at odds as extremely as they are in the US and the UK, that sets the stage for potential bad things and disruptive crashes in different sectors of the market.
Michael, what's playing out in the UK right now? Do you think we could potentially see that then here in the US?
the U.S. has always been blessed by two oceans and having a reserve currency status. And we are the most liquid markets in the world. So we get away with stuff that no one else can get away with. So it's hard to predict when and if the crisis that happens in the UK could come back to the U.S. But I'll go back to September of 2019 as a potential warning shot. September of 2019, people don't remember this, but that's actually when the Fed began printing money. And they started printing money despite 3.5% unemployment and a healthy economy because we had a $1 trillion deficit and private markets weren't able to finance it comfortably at prevailing interest rates. So the Fed stepped in, printed money, bailed out the Trump administration. That's exactly what's happening in the UK. The difference being is that printing money when inflation was 2% is one thing. Printing money when it's 8.5% creates a whole lot more problems. So I think we could see the financing problems that we saw in 2019 potentially without the Fed riding to the rescue.
So, Michael, obviously, we're still expecting this period of volatility to last until the Fed is ready to pivot or change direction. In terms of if you have a short-term investment horizon versus a longer one, what looks attractive to you right now?
So short term, I'm afraid only cash is king. And I have tried to step in front of this freight train several times because the good news on inflation, I bought into it because it's true. But we had a reminder, what matters is what the Fed believes. And for short term, cash is king. Longer term, when the 20-year Treasury hit 4.25, when the 10-year Treasury hit 4, 2 years from now, 3 years from now, those are going to be very attractive rates because the only thing that's making rates go up is the Fed tightening. The more the Fed tightens, the more the dollar appreciates relative to every other currency in the world, the more prospect for a global financial crisis, and everybody's going to run to treasuries, particularly at 4%.
All right, we do thank you for your insights, for joining us this afternoon. Michael Jones, Caravel Concepts CEO, thank you so much.